Yeah.
Yeah, it's like you're thinking it's like a holding pattern, like, oh, I'm just gonna wait it out until these really long ones go away and they go into tasty, and then you're like, oh, but I like this one now, so I'm just gonna take it. And tasty, great. I'm
Yeah,
taking
but
some momentum.
it's the little stock call spread stuff, so I can get out of that
Right.
at any time, you know.
Right. What I do is I do all the stock trades on Thinkorswim. I still leave it open, and then all the futures trades on Tasty Trade
That's
because
what I'm gonna do. That's what I'm gonna
doing the spreads, it really won't matter at all because it's a defined risk trade. You're going to use up to $500 or so per spread, so it won't really make a difference where you do it.
Yeah, that's what I'm gonna do. The pricing is better. I like being able to group it better on Tasty where I can follow it easier.
Yeah.
So that's why I'm gonna make the move. And I'm gonna probably add a little bit more money to it.
You know approximately how much you're going to do, like percentage wise, on the stock stuff versus the futures.
Um, don't know, haven't figured that out yet.
Well, just based on like what your preferences are, if you like more of the spreads or more of the futures, like what percent you might use in each. Just
From that answer, I'm gonna be 90% futures.
yeah, yeah, I'm pretty close to that too. Just like the SPX based, one tweet for a stock just plummets it and then you're screwed. But it's usually
Yeah,
not going to
yeah,
happen for anything else.
yeah. And I'm not gonna. I used to try to hit the home run, and if I get up, if I do like on Dick's, I think we're up like what, 40, $50 right now. I mean,
Yeah,
I even thought about closing it. Just take my $50.
right. I don't even remember if I'm in that anymore. I think I'm out of it. I'm
I
not
never
sure
saw
if I
you. I never saw you put the close thing, but maybe I just missed it.
DKS. I'm still in it.
Yeah, thought so.
I felt like I was out of it. I don't know why. There's so many random things that are there.
Well,
It might be worth closing it,
it
but
yeah, it's
you could probably let it expire worthless and still be okay anyway.
so the shorts at the short
200.
at 200 in July, and we're at 222. So yeah,
Yeah, that's a 10%, a little over 10% out of money. That's good.
yeah,
It's up to you. Either way is going to be okay on that. If you want to close it now, if you know another position you want to take, or you just wait and just let it expire worthless, most likely.
yeah.
I don't think it has earnings in between it. Let me look it up. Um, oh wait, is there earnings tomorrow?
What? There's some hamburger meat
I'm
there.
seeing a blue line on TC Trade when I just looked it up.
Yeah. Okay, but would you come? Oh, to give mom that money.
Um, I'm
Hey,
also
say hi to my
seeing
son.
August. I'm seeing August 20th also. When's the earnings?
What's going on?
Hi, how are you?
Pretty good.
Do you trade at all?
Yeah, I started to teach him some things. See,
Is that your son?
uh-huh.
Oh, okay. If he wants to, he can join the Discord. I'll let him in for free
Oh, cool. All right.
if he
Well,
wants.
I'll
Yeah,
tell
we
him
have a
that.
few people where their kids are in Discord too. I don't mind
Okay.
just adding them in there if they want.
That'd be great, man. Very
Just
gracious. I'll let him know.
yeah, just send me his Discord account name and I can send you the invite. Just send me
Cool.
a quick email. I'll send you an invite for it.
I'm teaching you some things. He was doing some spreads for a while.
Good.
He's busy. He's working, so
That's good. Yeah, might as well start young. I like helping out some teenagers are doing it too. I guess they
yeah.
have a uniform gets to minors or they're just having their parents' account do it. And then when
Right.
they're 18, they can switch it over if they want.
So what you were checking on Dick's?
Yeah, let me look on that. It says June 13th on Tasty Trade, but I don't think that's right. You see the little blue line here? June 13th? I don't think that's right though, because I just checked on Google. It's showing August. The last one's in April. It's not going to be already. I think it's fine.
Right. Huh.
Yeah, I don't know. Sometimes they're off, just when they're actually placing them or not.
Hey,
But
go back to how'd you open that up with news? A little arrow up at the top in the square.
I just typed in DKS on Tasty Trade and it shows this because it usually shows when the earnings are on Tasty at least. If it's like a random one, it'll show. Oh, there's a purple line. I forgot what they are. It's a blue line. I don't know what that is.
Your D for the
Dividend?
dividends? Okay,
Dividends.
dividend. Because the E was earnings, the D's probably
Yeah. It's weird how the stock went up even with the dividend coming.
It was
You gotta,
it was up more this morning. I was like at $50.
yeah.
Now I'm at like $35.
If you go to NASDAQ.com, they show dividends pretty efficiently. Yeah, it's on the 14th. So the ex div, you got to buy by tomorrow if you bought it. You get $1.10. Yeah,
Oh,
so it might go down a little bit after that, but it's probably not dramatic. Like it might go down $1, but it's already up so much. I would probably just let it sit.
yeah, okay. Oh well.
Hey Joseph, how are you?
Good.
Good. Open mic, open questions as you guys have them. We're just look at the market otherwise.
Yeah, Lance, I want to know how you are identifying the stocks that you're doing spreads on. I look at some of the charts after you post the alert, and I'm like, I don't know what he's seeing that I'm not seeing.
Main things I look at are for recent support or resistance. The GME one today is a little weird. I mean, that I just saw is 50% out of the money, so I thought that's a really good cushion. And it's like there was no other rhyme or reason for this one today. Because it is hovering around 11, 12. But if I look at some of the main big stocks, we're not on Microsoft right now. See, it was a bounce at 405, but we've been really bullish on it. So I wouldn't be able to sell down to the 405. I usually look for a recent bounce, and if I could sell below it, and it's also bullish, that's usually the main thing I look at. We're really bullish right now. I don't have RSI on this chart right now, but I'm guessing it's going to be really high, maybe above 70. So if I see RSI also increasing, like the slope of the line the last week or two has been increasing, above 50 usually. And if I could sell below a recent support, I'll probably do it. So we just look at random stocks and see. And this is how I do it. I have a watch list of like 50 companies and I just browse a few until I see one. Amazon, Microsoft are almost identical. If you see that bounce right here.
Uh-huh.
Here.
What's your blue shaded pattern? That's your
This is a Lux Algo indicator. I said I was going to be an affiliate for them and hype it up, so they gave it to me for free, and I never hyped it up besides once. They still gave it for me for free, so I still have it on. On Thinkorswim on my phone, I'll usually just look at EMA, the 21 EMA, and if it's above it, it's usually bullish. If RSI is increasing above 50. The blue line means that it's, I think, a delayed bullish. These little triangles show if something's bullish or bearish. If you look at, say, the daily or in the 1 hour, I usually look at the daily chart. So right now on the daily chart, for instance, it's a green with a little plus above it. That means that it's really bullish. And then the blue line is kind of showing the trends. That's a little bit delayed, I think. But don't quote me on that one. I don't remember exactly. But yeah, recent bounces off support. So here, 170 it bounced. I'm not going to open up Thinkorswim right now, but if I could sell a little bit below that 170 or at 170 should be probably okay too. When you see the bounce here at 170, it was a little below it, then it recovered. You could sell at the 170 right now, 0.16 delta. And then I see is the credit worth it. That's probably a good trade, to be honest. You're getting almost
59 cents is good.
Yeah. And it's at the 70. If you want to go safer, go 165. 32 is not horrible. It's a big ass spread right now for that. So if I could get at least 30, if you want to be safer on it, you go 165, 160. That's the type of trades I used to do a lot like last year. Now with this 5K stuff, I sometimes go a little bit more aggressive. So the 170, 165. Those are both fine, I think. Yeah, still relatively bullish. It bounced off 176, bounced off 170.
That's your daily candles you got on there
These
right
are
now?
daily, yeah.
Yeah. 1, 2, 3, 4, 5. That's a week's worth of going up.
Right. I use anchored VWAP for futures mostly, but occasionally I use it for stocks. So I want to see what the fair price is on the stock based on a recent high or low. So I'm going to move it to this low right here. And then this blue line shows the average price that people paid for Amazon from here on. And right now, the average price is around 182. We're above it at 185. That's usually a bullish indicator. So if the candle's above this line, it's usually an indicator that will stay above it. It might, if it starts to turn a little bearish, it might turn bearish to that blue line again, and then it might consolidate a bit because that's where it's a more fair price from people that bought here.
That's a pretty, yeah, once it flattened out, it stayed flat for a while.
Right, which is fine for spreads
Yeah,
because we're
yeah,
still
no, that's what I mean. Exactly, yeah.
this should be a good trade to be honest. Sometimes it's that quick. Well, I'll just type in 2 or 3 symbols and I find it. Sometimes it might take me 8 or 10, and then I just forget. I don't really overthink it too much in the end thought. Like I just pick one and then go with it. Sometimes there's analysis paralysis. You're never going to find everything that's perfect, and then you just go and not worry about it. There's other things in life to worry about, I think.
I kind of like Tom King's deal where he looks at the weekly and then the daily, and
Right.
didn't put a whole lot of thought into it.
Right, which is fine. I just don't have a ton of time to do all that stuff sometimes.
Right.
Joseph, Ricky, how you guys doing? You have any questions?
Yeah, I was hoping to go over the strangle today. I don't know if you could do a quick.
All right.
I don't know if they're interested.
The 6E one or the gold?
Oh, either or. I'm just trying to understand a strangle, like how a strangle, even the basics would be. I mean, I kind of get it, but I want to make sure that I
Like how to enter it right, you mean, or why I took it?
like kind of how it plays out. What am I looking to do? What are my management?
Okay.
I've done nothing with strangles
Okay.
so far.
All right, so I already
Like,
drew on this chart a little bit for the gold strangle. I sold a put credit spread down at that green line. This is the sold put. I sold a call credit spread. I think it was 25.50. Let me double check. Let me just see the gold position real quick. Gold 26.50. So that was a missing line there. Yeah, so I sold the call credit spread 100 with this way, sold the put credit spread 100 with that way. In a strangle, you're taking in credit on both directions. You're taking one on the put side and taking it on the call side. So obviously one side is going to work out because we can't be at the green line at the exact same time at expiration. So what's good about that is you use a little bit less buying power than if you did each one separately on, like, say, 2 different positions. Like if I did a gold one here and an oil one there, you're going to need a lot more buying power for it.
Right.
In order for how to place the trade, pretty straightforward. So this is when I did 76 days. I sold the 2150, bought the 2050. Just click the bid for the selling, click the ask for the buying. If you want to make it a strangle and you have a large account, you could just sell the 2150 if you want. And then do the same thing on the call side.
That's what I was about to say. It's really an iron condor. It's not a strangle.
It is an iron condor, yeah.
Yeah.
Which I said you could make it a strangle if you have the buying power and wanting it.
Sure. Right.
The strangles in general will decay a little bit better than iron condor because with those bought puts and calls, it's going to slow down the rate of decay because those are losing value. So you're sometimes in the trade a little bit longer because of it. But otherwise, strangles are more buying power efficient in general.
Yeah.
If you have it.
If you have it, yeah. But like this trade took about $1,700 in buying power. If I just made it a strangle, so sell the 2650, sell the 2150, you need 3,700 in buying power. You do take in more premium, obviously, because you don't have to buy those puts and calls that are further away. However, you're still getting very good buying power efficiency. I'll be right back. see if my wife is asking me to do random stuff around the house or not. Nope. Okay. Joseph, did that all make sense?
Yep, okay, I get that part of it. Now what about management?
All right. So once I was in the position, I first made a group of it. So you highlight all the positions,
Right.
right click, and then name group.
Yep.
I typed in Iron Condor. I wrote the line number on my spreadsheet.
Yep.
So if you go to the spreadsheet, it's under strangles and naked, maybe Iron Condor 2. Line 51's right here.
Right.
So it's easy for me to find where it is because I have a lot of trades on. So I wrote Iron Condor line 51. In terms of managing that, typically look for 50% profit.
Yeah.
So I took in 6.3 on the trade. You could do close position 50% profit, and that's it. And
Okay.
then make it a good till canceled order though, so it stays
Yep.
on. So right here, the GTC.
Sounds good.
You could
Sounds
also just
good.
manually. I usually just manually type it in too, but it's the same number in the end. I already have
Okay.
that order, so it's not going to let me do it. But, or did I?
Yeah,
Okay.
that's perfect. Perfect.
Yeah, I guess I forgot it. That's all you do. In terms of losses, I look at the P&L open percent. You want to add that column to your just main position tab. Just click on the gear icon here, and then add the P&L open change percent.
Mhm.
This will show the percent profit or loss on the position if you close it out. So this one right now, I'm already up about 7% on it. If this shows 50% in green, then most likely I'll be able to close it at that 50% or very close to it. If this is at negative 200%, then I'm going to stop out of it. So
Okay.
this one,
Negative.
unfortunately, you'll have to visually see it. You can't place a stop order on futures, unfortunately.
Okay.
So this, like, just once a day, just check if your P&L open percent is getting close to it. If it's like negative 100 something, then just keep an eye on it. Otherwise, just let it sit there, let it decay out, and then it'll usually work out anyway.
Sounds good. All righty.
And then think about the percent of your account you're willing to lose on that. That's probably the more important part. So I'm personally okay with losing up to 3% of my account on any one trade. It's a little bit high. You could go lower if you want to, 1 or 2% of your loss. So just simple math here. Let's say I had a $50,000 account. If I'm willing to lose 1% of it on one trade, I could lose up to $500 on the trade. Does that make sense so far?
Yep.
So if you're taking in a trade that's taking in, let's say 250,
Yeah.
if you get out at a 2x loss, you're going to get out at 750. Do 750 minus 250, you're at $500 loss right now. And then that would be fine with your account size. So that's how you can do some simple math there. When I took the trade on, it was, let's see, let's put it on again. So I took the trade on, it took in 6.2, I think. It was around 6.2 when I took it.
Right.
So I'm willing to lose up to 3 times as much of that when I stop out. It would be about 18.6. But I'm going to subtract the 6.2 that I took in. So I'd lose 12.4 if it stopped out, which would be $1,240. Right now, for me, that's about 2% of my account.
Okay.
So that's why I did an Iron Condor. I also am going to be on vacation, so I don't want to be taking on too much risk on it anyway. But I could be fine with a strangle on it if I wanted to. But if you look at the strangle, I'm taking in a lot more. So if I just sold the puts and not bought the puts and calls, I'm taking in 1040. So I'm taking in 1,040. It's a bit high because times it by 3, 31.2 minus the initial 10.4. I would lose $2,080 there, and that's a little over 3% of my account.
Right.
So that's one main reason why I did it as an iron condor. With 100 width is a pretty wide width. So these are the type of things you want to be able to calculate before you enter the trade in terms of what percent you're willing to lose if it does stop out. And then, like if I took this trade with like a $30,000 or $40,000 account, I'd probably be stopping out before I normally would. Like it wouldn't be a negative 200% loss because I'd be already losing quite a bit, and I'd probably get out earlier than I would like to.
Right.
I don't know if that all makes sense or not.
Yeah, yeah. I get that. Yeah, it's all making sense. I got it.
Okay.
So 2% of what you for me, I guess it would be around 2% would
Okay.
be acceptable. And then basically you manage at 50% profit, which means you just exit the trade altogether at 50%
Exactly.
profit.
Yeah.
So perfect. Perfect.
So if you do the
And
number just with the straight numbers of that, for every
yeah,
time you win one, you'll have to. So every time you lose one, you have to win 4 to break even on it, unfortunately. Like
okay.
just to keep the math simple, let's say you took in $1,000. I'm going to close it out at $500.
Yep.
But if I stopped out, I would stop out at 3,000. It'd be 3,000 minus 1,000. I'd lose 2,000. So that means I
Okay.
need 4 winners to offset the loser
Right.
because I'm
Okay.
taking 500 times 4 is 2,000. The thing,
Yep. And what I'm
yeah,
looking at here though is it's got a 90%, according to your screen here, 89% probability
exactly,
of profit.
exactly.
So I mean, it still seems like a good trade to me.
Yeah, so pretty close to 9 times out of 10, this trade will work out. It's going to
Right.
be a little less than that because we are stopping out. If you just held it to completion, because you're stopping out at say the 3x loss, it's going to be lower. I've heard different pretty deep diving this, and I don't have a clear answer on what the percent is. It's going to be at least a few percent lower than that, but still, it's going to be higher than 75%.
Right.
So yeah,
Okay.
it's just all like a probability game here. If you do these over and over for many hundreds of trades, you should win out more than you lose. I know Tom King does a lot of that too, just looking at the probabilities. Um, it's a little bit riskier than, say, the safeguard trades. Those just have a higher win rate in general, and there's other things you do to manage it. However, you're not as buying power efficient on them. So you're using up more buying power to take on those trades. The strangle is pretty much the most efficient buying power trade you can do. He made a video last night, by the way, if you want to look at it, about strangles.
Who did? You
Oh,
did or Tom did?
He did.
okay.
I'm nonstop. Middle of the summer, I'm still watching videos of everybody. I don't get a break. It's like, but I'm purposely watching these. I'll leave it on the chat. He said some strangles with like a concert, Strangle Palooza.
Okay.
Oh, I did see that. I didn't watch it, but I saw it. Yeah.
I left a link on the chat if you want to watch.
Okay.
Okay.
Yeah, I'm personally okay with using about like up to 10% of my account on the buying power plus cash on the side for these type of trades. It's not going to break the bank if I stop out on a couple because I'm only using about 10%. But if you want to be a little bit more aggressive and you're okay with those probabilities in terms of stopping out and all that, you could go higher if you want. Just realize that you're going to have some losses, especially when markets move a lot.
Yeah.
And
Sounds good.
let's see what SPX is up to. I don't know if I think he's talking soon, right? Or is he already talking? I think he talks like 1:30, right?
1:30. Yeah. Well, yeah. Well, he usually talks at 1, and then 1:30 is when he has his little
Yeah.
powwow.
It's like the mannerisms, like how he actually like touches his head and stuff matter a lot. He has so much power.
It dipped a little bit from the
Yeah.
high from the
We're
highs.
we're nothing dramatic here. Let's look at the whole day. We're pretty much a little bit higher than where we started in the beginning of the day. I'm purposely not taking many trades for a few reasons right now. One is the VIX is really, really low, 12.5, 12.3 or so. And I'm on vacation next month and I have no internet. So I'm just going to leave trades on and not do anything about it besides just take profits if it happens to hit based on the automatic ones.
And Lance, I'd love to hear more about, there's somebody in the Discord, I won't say the name since this is being recorded, was doing a single naked put on ES at about 30 days and taking it off at 50%. And you said you guys were talking through that. Have you looked into that anymore?
50%?
He was taking a profit off at 50%. He was putting on a 30-day trade on ES on a down day, trying to take $20 in premium.
$20?
And then taking it off at 50% profit.
It's a pretty high delta.
It was in the 15, 16 delta range, I think.
It's even more than that. Look, ES 30 days out, 20. Yeah, 0.2 delta or so. And then he's taking him off a 50% profit. Okay. I forgot what his stop loss is or if he's wheeling it or not. He might be
I
wheeling
think
it.
he was willing to take assignment
Yeah, you have to have a really large account for that.
for
Uh-huh.
one ES.
Yeah,
Yeah.
because if you get down to say the 53.50, every point is $50. It adds up pretty fast if it keeps dropping. I mean, it's a little similar to my covered strangle strategy. I'm going similar DTE. I'm going similar premium on the first one. And I'm trying to go for a higher profit, 75% instead of 50.
Yeah,
And
on
I'm willing to
MES.
wheel it too. But I'm only doing that with MES. $66,000 account MES. I think I can handle it. ES, nope. But
Okay.
if I had a $660,000 account, then I could do that with ES if I wanted to, I guess.
So basically on your MES covered strangles, you're selling a pretty high delta, hoping to
Right.
get, well, not hoping, but if didn't to get a good premium. And then if
Yeah.
you get assigned, then you just sell a covered call on it basically.
Exactly.
At the money or a few.
It depends on that one. By the way, I'm almost 75% on the current one. 63 already in only a week. Hey.
So
The
at
strategy
50,
works really well in a bull market, of course, because you can just get these profits that are higher initial premiums and just get out of them. But
so
yeah,
you don't take those off at 50 either?
I take those off at 75% profit.
25, okay.
So I'm pretty close already. And then the timing might be weird because I'm going to be on vacation pretty much a month from now. So I'm willing to do the next one, assuming this closes out of target profit. I'm willing to do the next one at where it expires at least a week after. So I don't know when that's going to be yet, but I'll probably do another 40, 45 days out.
I know Tasty will let you do it now, but do you have to take those off in two separate closings or
You could close it all at once. I have an order for it. What's annoying about Tasty is finding your working orders. So I don't know if any of you guys know a better way, but I gotta find where I actually put this in. I think it's no. Did I even put it in? I probably did, but it's gonna probably say error, you already have one. Or maybe I didn't. Yeah, see, I already have an order. I don't know where it is. Does anyone know a good answer to that? Besides just finding it?
On it, can you go can you search by GTC at all?
I would go to others. Is it in that list?
No, it's not MESZ. Or it's still MESU. It's in there. On my phone I can find it quicker. Oh, here it is. Yeah, I don't know if there's a quicker way than just manually looking for it. But anyway.
Go by the date, maybe. Just kind of.
Yeah. Yeah, so I just put the GCC in right after I get filled. So I got 46 on it. Times it by 0.25. Because that'll be a 75% profit. So I put a closing order at it as 11.5. I think I did. It was pretty close to that. Yeah, 11.5. Now, as for if I get a sign, where am I going to sell calls against it? That's where you get very flexible and interesting on it. If I got a sign, you could sell at the money if you want, and then you wouldn't gain anything on the actual contract, but you would get premium selling a call against it.
You get the premium.
You get the premium. You could sell out of the money if you're willing to be more bullish and you think there's going to be a big recovery. And then you can make some on the actual contract. So let's say I got assigned at 40, where is it? 5170, I think it is. I have so many positions. Yeah, 5170. Let's say I got assigned here. I could sell it, and then let's say I think it's going to bounce up. I could sell a call maybe 5200, 5250, something like that. You won't get as much premium here, but you can make money on the actual contract that you got assigned on.
Yeah, you make the gain on it, capital gain on it.
Exactly. You could also sell in the money covered calls. And it sounds like it's a little weird because you will lose some money on the actual contract, but you take in more premium that way.
It's a
So
trade.
then on the call side over here, obviously if I'm selling more in the money, the premiums are higher. So if you think the market's going to continue to drop, selling an in the money covered call could make sense there because you're taking in more premium. You'll lower your cost basis on your contract you got assigned on.
But then you get assigned again.
No, you already have the contract. Let's assume you already have a contract. So let's say I bought one right now, 54.95. And then I think we're going to be bearish right now. Just guessing, obviously. Maybe a week out, I would sell. Well, this is MESM, 54.31. Let's say I owned a contract right now. I could sell maybe a 5400, and I could take in 47 or so premium off it. I would lose 30 from the difference of the contracts, but I'm taking in 47, 48.
Ah, okay. So it's not like a stock where you get put more shares. You just lose the difference.
No, because I already own the contract. If I'm selling a call at it, and let's say it ends above it, let's say it ends around here, I'd lose my contract at that point because it went higher than where my call is that I sold.
Sure.
So that's a safer way to go, going in the money calls.
Interesting.
It's a little different than just stopping out. But selling in the money call, if you're patient about it, you'll take in more premium. It could make some sense depending on where the stock is. Like if I was assigned at 54.50 or so it's a little higher than the current price. Let's just assume I was here. And let's say I think the market's still going to drop a bit, which usually it will if you're already assigned anyway. I might sell a 5400. And then at that point, it's pretty much a break-even trade because I got assigned at 54.50. Don't worry about the premium I took in when I got assigned. But let's say I got assigned 54.50. 50 away from it is paying 50 premium, right? So in that case,
yeah, $50 difference, but you took in the 50.
Exactly. I would pretty much break even at this point if it closed above 5400 instead of the initial 54.50. Does that make sense? I kind of said it pretty quickly there. Does that make sense, guys?
I see the difference. Yeah, I see the $50. You're going to lose $50 on the contract, but you took in that 50 on the premium, so it's a wash.
Right, exactly. So it'd pretty much be a scratch trade then. But if the current price is 54.33, you get a little bit of downside protection. You're getting 33 or so points. You can still drop a little bit, and you can still get out of the trade at a break even on that. So yeah, selling an in the money covered call is a safer. It's more conservative. You won't make as much money that way because you're losing on the contract. Essentially, think about like max scenario. You're selling out of the money calls like here. You won't make much premium, but you can make a lot on the actual capital gains on the contracts. You go in the money covered calls, more conservative. You can still let the market drop a little and still get out of it. And in between is selling right at the same strike you sold it at or bought it at, got assigned at. It's very flexible. There's not really one set thing I'm going to do with that. It's more of like, am I willing to be more patient and stay in the trade a little longer than I might sell more out of the money, possibly.
Patient. I don't have
That's where it's more of like an art than a science. Like I don't have a set thing I'm going to look at for where I'm going to sell the call.
Yep.
But yeah, I'll definitely let you know what I'm going to do when it happens. But we haven't got a sign. I don't think we got a sign at all this whole year on a covered strangle, right?
We came really close on the last one, right?
We did. And that was so ridiculous. I did a live stream about the strategy. And then, of course, someone was like, yeah, well, why is there such a big lag in the dates here? Like it went from 226 to 5-1. Like what happened? I was just waiting is what happened. I was like, they're going to complain about anything. It still worked out, and I still got out at the target profits. But, you know, whatever. Yeah, I haven't got a sign yet this year. All these have got 75% profit. And last year was really good too. We only got to sign like 2 or 3 times all year. But it's a big bullish market. So
What? Okay. Just a quick question here on the assignments on your. This would be the MES, right?
yeah, these are MES.
Okay, so what would be the total cost of an assignment? Like what kind of buying power would that absorb?
Good question. I just make it $3,000 as just a rough estimate.
So if you
I'll show
took
why.
assignment, that would cost you 3,000.
About it's a pretty conservative number. There's not an exact number. Let me show you the
That's pretty
reason why.
reasonable. Yeah.
So, like, let's say I sold 37 days out. What I typically look at is the expected move. Right now, the expected move is like 172, and we're at 54.96. I actually do this on the calculator right before I take the trades. 54.96 minus 172. I'll also sometimes look at Thinkorswim's expected move. They're usually different, by the way. And usually Thinkorswim's a little bit more conservative on this number. So it's usually a little smaller. But anyway, subtract that. 53.24. I'm going to look to sell a put very close to this, usually slightly lower. So maybe 53.20. So like right here, I'll sell a put. And then I typically look around 100 points below it to sell the second put. So around 52.20.
Yeah.
See the buying power effect, 1691.
Yep.
So if you double that, it's close to 3,000. If
Okay.
it went all the way down to 5,200, let's say, I would need the 1691. I'm going to leave that extra cash for my span margin requirements. I did take in some premium. I took in 36 total premium on it, assuming I got a sign on both. And then I'm going to still sell calls against it anyway. So it could look like it's a little over 3,000, but remember, I'm taking in premium anyway when I'm doing it. So 3,000 is a pretty good conservative number in most cases. Obviously, if the market tumbles and drops completely, you're going to need more than that. But 3,000, I think, seems reasonable to me. That's just how I came up with it. Good question.
All right.
This is the most riskiest strategy that I do because you could get a sign and it could keep dropping. And I'm selling higher deltas. But it's a way to possibly boost the return. I don't mind getting a sign on an MES. Again, $66,000 account. I could use $3,000 and wheel it. It's not a huge percent of my account. I was doing this when I only had like 20 grand in there. But
Right.
luckily I was working out then.
Yep.
Total, you should probably have at least a 20 grand account if you're going to do the covered strangle. Because if you're using up 3 grand of it, and you had say a $6,000 account, that's a really high percent. So I would probably not do it unless you have at least 20 grand or so.
20 grand to do that and some other strategies.
Yeah, I mean 20 grand total in your whole account at least. Because if you're using 3 grand out of the 20, you're using 15% of it.
Mm-hmm.
That's already pushing a little bit. But if you have less than that, then it's even higher. And this strategy is 3,000 off 66. It's not that high. 4.5%. One day I'll get a sign and I'll tell you what I do. But until then, I'm just gonna keep making these 75% profits.
Hey, can't go broke making a profit.
Yeah, that's always a good line, right? It's like no one ever got broke taking profits.
Right.
There's more to it.
Right.
Yeah, it's like, yeah, you do that, but then you're doing the next trade, and then it might be a higher strike, and then it tumbles, and then you're down even more because you took a new trade. But I mean,
Greed kills.
greed does kill. Then why am I doing GameStop?
Man, I almost jumped in on that this morning when I saw you post, but no. I got bit with AMC, so I'm out.
Oh yeah, it's risky. I keep saying that, but people are like, "Oh, I'm going to do it because Lance did it." No, don't do that. Anyway, I did this on Thinkorswim just to keep the accounts separate, but I bought a 20 call. It was around that. I think it was a little less. It was around $1,200 something dollars. But then I want this to possibly go up, obviously, because then the leap will be worth more. But then I'm looking to sell calls really far away, just lower the cost of that. I think I sold a 50.
I think you did, yeah.
So if GME went up to 50 in the next 2 days, sure, this is gonna, let's say it went past 50, it's gonna be more than that. I'm gonna lose on the sold, but I'm gonna make so much more on the leap. It's still a really good trade. If you look at the deltas, it was, oh man, that's a lot of volume for 50. People are buying up. Look at this, 13,000 contracts at 50 when we're at 27. That's crazy. Anyway, I sold that one of those to someone else. I hope they work out and they make a lot of money because I made a lot on the other side anyway. I sold a 55. I sold the 55 this morning. I took $85 in. It's already at $52. Now, this strategy only works if GME stays where it is, goes up any amount up to like the 55. If it drops a little, it's going to hurt at first. But I'm going to, if the volatility stays high, I just do this every week. This is the crazy week where Roaring Kitty has his 20 calls. And of course, there's a ton of volume again. Just go 9 days out and sell something really, really high, like a 60, you make $145. So the main thing I'm trying to think of is how do I lower the cost of that bought leap that I bought? I bought the 219 at 20. I bought this for, I actually spent a little more. I spent 15 and change. So I am down a little on the trade because it went down a bit. But my main goal is how do I make back around the $1,500 I paid for this? Does that make sense?
Yeah, so you're trying to figure out how to get back the $1,500 you spent at $150 a chunk.
Or about. I mean, I want to look for trades that are very, very far out of the money for now. Because if it does shoot up, this sold call could be worth a lot more and I could lose money on that. But yeah, if the market drops, then I'm going to have to sell closer to the current price to make it worth it. It's essentially I bought a ticket to a clown college and there's people going crazy in there. And I'm assuming that this is going to be worthless. There's a good chance that this is worth zero at some point. If it's worth a lot, I'll take it, obviously. But it's a risky trade. I'm not saying it's not risky at all, but it's very tempting to take in, $85 off 1,500 in 2 days. Let me look at the numbers. Yeah, it's like an $85 off 1,500. 5.5% in 2 days. I'm trying to say the negatives to it more.
So
'Cause-
you could let's took in your $85, let's say, and
Yeah,
then in a couple of days just buy back the $1,500 and
maybe. It depends on what happens to the stock, obviously.
yeah,
If
but
the
I'm saying
stock,
that it's something you could do.
yeah. No, yeah, I could get out at any time. I could get out today or right now if I wanted.
Yeah.
I'm gonna
And-
let it go a little bit. I have 200 days. Um, mm. So if the market drops, this will be worth a lot less, and then I would have to sell calls a lot lower than I am, just because it's not going to be worth selling really far out of the money, most likely.
wait. If you sold it, why? You sold it. Why? It's going to be worth more if it drops,
I
right?
meant the leap will be worth less if it drops. This is a bought call. So I
Okay.
bought this.
Yeah. Okay, gotcha. Right.
This will be worth a lot less if it drops. And then the weekly solds will be closer to the money to make it worth it. Because if the market drops, I can't go out to 55 anymore. I might have to go to like 40, 45, wherever to make it worth it.
Yeah. Everything moves together.
Right. I'll be perfectly fine if GME stays where it is. This could be very good. If GME moves up, it could still be very good. If it shoots up to the moon, I'm still very good because I'll just
Then
get
you're
out of
very
the
good.
trade. The what?
Then you're very good if it's used to
I'm
the
very
moon.
good if it shoots up. If it went up to the 55 right here, sorry. If it goes up to 55, I'm going to be losing on this, but then the leap will go up pretty much $1 for every dollar it goes up. The delta is 0.81. So that means every time GME goes up $1, I gain about $81 off it, off the leap. But pretty much I got to look at the differences in the deltas. Every dollar it goes up right now, I make 81 here, and I lose because I sold this one. I lose $11 here. So I'm up about $70 every time it goes up $1. Does that make sense?
Mm-hmm. Still positive.
But
Is that
now let's say GME shoots up to 55. At that point, this delta will be near 1 at that point because there's only like a day or two left. At that point, this might be gaining more than my leap would for every dollar it goes up. And then at that point, I have to get out of it. What I also was sorry, 1 second. I can put some alarm on this tablet. I don't even know what's going on. Sorry. 1 second. Sorry, my kid put some random alarm on her tablet. The difference in the delta is what I'm going to look at. If this delta on my sold weeklies or so ends up being very close to my bought delta on the leap right here, I'm going to get out. And it'll be a good profit in the end. Whew, all right. Any other general questions?
Yep, quick one.
Yeah.
How much would you say you should have in your account before you do a safeguard on ES as opposed to MES?
Ideally, you want to be able to campaign them in where you're adding them in every 2 weeks or every month and not just thinking, I have enough to do one, so I'm going to do one, and I'm going to wait 100 days before it closes out. So each ES, I think 11,000 is okay. Ideally, you could do at least one a month. So 120 days is 4 months of trades. Do 11,000 times 4, about 44,000 or so for just that strategy. Like obviously you're doing other strategies too, you need more. If you look at my trading plan I have, I'm gonna open it up. The $66,000 account. I think I'm designating around 40 something to it. Let me find it. Position sizing. I'm doing 41,000 on just the safeguards for ES. And I'm doing MES too in there. So here's how I set it up with just the safeguards. Each ES is 11,000 or so. That's the initial buying power you need, plus the cash on the side. And MES is about a tenth of it, $1,100. And then I'm squeezing in a 300 with put credit spread. So instead of just a naked put, I'm buying puts 300 whips below that. It's about 4,000. And I just did one recently on it. So if I'm using about 40,000 for the trade, I can't do an ES. I'm doing an ES every. Yeah, that's right. No, that's off. Oh, no, that's right. I'm sorry. Yeah, I can't do an ES every month because that's 44,000, right? So because of that, I'm doing a 300 with this month. So I only need about 4,000 for that trade. And because of that, it ends up being enough to do an ES every month except this month. Does that make sense?
Yeah, that's great. Yeah,
That's a stunning,
Helps
tasty
out a
trade
lot.
too. Not think or swim. You're gonna need more.
yeah. But with the up move today, I took some of the naked puts off with
Yeah.
they
Yeah,
weren't
that's
at
good.
90%, but I thought, gee whiz, I'm at 75. I might as well get out of that exposure.
Right. Yep, I did too. I was like 88 or so. What I essentially did was I had my $66,000 account. I'm willing to use this much for this strategy. And then I backtracked how many contracts I could do. So if I'm using about 41,000, I did 41,000 divided by 1.1100 because 1100 is one MES. So I could do 37 MES trades and ES is 10 MES. So essentially broke that down. I did an MES every month. That's 30 of these out of the 37. So 10, 20, 30. I have about 7 or so left of MES. So I did one MES on the every 2 weeks like that. And then I have 4 left. So I did the 300 left. That's how I figured it out. I kind of went backwards. How much am I willing to use first? And then I figured out how many MES and ES I could do from it.
Yeah, that explanation is awesome. Thank you.
Yeah, it's really that. So I can do 37 MES, 3 ES, and 7 MES. This is a good trade, by the way, for lower buying power. So this is the one I did recently on ES. Get rid of all that. Yes. Nope, Z. All right, so this was a 300 with ES trade I did. It's the same normal strikes, but I bought 2 puts 300 widths below it. So I bought 2 of the 4150s. Normally I would just do these. That's just a regular ES. But by adding this one on, you only need about $4,000 instead of 11,000. Obviously your initial credit will be less because you're buying puts. But it took in 6, that's $300 if everything expired worthless. And $300 off 4,000. Good percent, 7.5% right there. This
And
is
how many?
more small account friendly or IRAs, Roth IRAs, because this you'll use a lot less buying power than just doing that. I've helped a few members already that are doing these with IRAs, and I'm almost always recommending buy at least 1 put, sometimes buy 2 puts. Questions on that?
I'm gonna have to watch the recording. I stepped away for a minute.
Okay. I'm just saying I bought 300 with put credit spread here instead of just a normal safeguard because it uses less buying power. It uses about 4,000 instead of 11,000.
That you're naked, and then you went further down. I got you.
Yeah, so this is the normal safeguard. I bought 2 puts 300 width lower than the normally naked puts.
Yeah, the gray line. You added
Right.
it.
Yeah, I added it. So it makes it a put credit spread here instead of naked puts.
Gotcha.
But you only need 4,000 instead of 11,000 for this trade. And it has the exact same 50 width put debit spread that I normally do. And that's for ES. That could pay $2,500 if it went below 5,000. So you still get a good trap profit if it dropped to there. Let's fiddle around with this silly config percents like this. You got to do the scales all weird.
Yeah.
That's the one thing Thinkorswim's a lot better at. But anyway, still the max profit's $2,800 off this, and I'm only using 4,000 for the trade. It's a really good return.
Yeah. So you're saying this could be an alternative to MES?
It is an alternative to MES. Yeah, if you're kind of in between going from MES to ES, like you're almost at ES but not quite, I would consider this.
Account size wise, yeah.
Account size wise, because yeah, again, this is about $4,000. I would recommend this over like a 448 or like 4 contracts of MES because you have that bigger trap profit right here.
Mm-hmm.
$2,500 instead of 4 times 50 times 250. Sorry, 4 times 250 is 1,000. If you did 4 MES normal safeguards, you can make 1,000 on this trap, but ES you make 2,500 on the trap.
And the buying power is
The buying power is about 4,000. So it's almost the equivalent of 4 MESs for a safeguard.
Yeah, so about the same.
About the same. Pretty close.
I got you. That makes sense. Okay, cool.
Within a few $100s. Yeah. But yeah, you won't make as much credit. I'm taking in 6, so $300 initial credit. If you did a normal MES 112, that's usually, let me show you how it works. Yeah, but trade. Let me get out of that. All right, so if I did just a normal safeguard for MES, your credit's usually around 32 to 35 or so. So we buy a 0.25, sell 50 away, sell 2 around 20 premium, change that to 2. Yeah, so I'm taking in about 33.25 on an MES. 166 for 1. If I times it by 4 of them, if I'm doing the equivalent, you're taking in more initial credit if you do 4 MES safeguards instead of this one. But this one has a bigger trap. Just trying to show the similar comparison of the two.
Mm-hmm.
And the commissions are less this
Let me
way.
ask you, where and how did you learn all this stuff?
I keep trying things like this, and then I see what happens a lot. I do this a lot. I just like click on stuff to see, like, oh, that's good. And I watch a lot of videos too, but a lot of it's literally just me looking at what the premiums are at certain strikes and what if I do this and do that.
Trial and error.
Fiddle around with it. That's how I was looking into the really large 300 width put debit spreads.
Yeah, it's just the downside, worst case scenarios that always freaks me out, or
Right.
is where I get lost. You know.
Yeah, no, that's true. This was a 300 width put debit spread one, and didn't take in much premium, but I have such a big width right here. That's another trade I like a lot, especially if the VIX goes up. The VIX is so low, I don't really want to do this, but I'm just waiting for the VIX to shoot up, and then maybe I'll do another one. Let me go over that. So I'll usually look around 180 days. We don't have that available for MES right now, but it will be really soon. Another one will pop up. You could do same 0.25 delta buy, go 300 with 1, 2, buy the 49.50. Still like to sell around the 20. Sell 2 of those. It's not much initial credit because the VIX is low, but you could eventually roll the sold put of the put debit spread closer to the 5250 and take in credit when you roll it closer to it. What I like a lot about this is you have such a big width on the debit spread. This gives bigger protection if the market drops, because this will give a bigger profit. It's not a complete, end all be all like great trade yet, but it does protect more. I'm just waiting for VIX to go up. I'm not going to do it yet. Let me go over the rolling. So this is one that I did 43 days ago. It's similar to what I just said. What I'm going to do, I wrote here, it doesn't show it, at 120 DTE, so 8 days from now, I'm going to roll the sold put of the debit spread. I'm going to roll this up. I'm going to roll to 150 width. Right now it's a 200 width. I'm at 45.50. I'm going to roll up to around 4,700. It's not paying much right now because the market's just shooting up. But if the market was dropping, this would give in a lot more credit. Does that make sense?
And you're doing that because it's so far away. You're just kind of coming up to it.
Yeah. As you get closer to expiration, the put debit spread will be more of a protection on your trade because you can make that trap profit on it. So because of that, I'm going to look to roll to take in a little bit more premium. This would be a lot better if the VIX was higher or if the market dropped.
Same
Right now,
expiration. Same expiration. You're just changing the strike.
yeah.
Okay.
So 8 days from now, I'm going to do a trade like this. I'll take in, it's just MES. We're looking at $15. It's not even really worth it. But if the market dropped, this might pay, 20, 30 premium possibly. Just got to wait. But what's good about this trade, again, you have such a big protection. 300 width right here, 40, 50, 45, 50. So the market drops initially, it's going to be helpful. This is another one I did only 16 days ago. Trying to move these so you can see it. I don't know what it's doing right now. Here we go. I don't like this scale stuff. It's not very intense, user friendly. Ugh, I can't get it to go. Wait. All right, that's a little better. This is the 300 width put debit spread. Really big range of profits there. And then I'm going to look to cut it a little bit soon. The pros and cons to rolling that put credit spread, the sold put of the put debit spread. The pro is you can take in some premium by rolling this up. The con is you have a lower width, so there's a lower trap profit, obviously, because you have a lower width.
Right.
It's a balance between the two. All right. Any other general questions? Should I deep dive? Deep diving random stuff. This is how my brain works randomly.
I see that.
Yeah, comes up all the time. Ricky, Joseph, any questions so far?
Yeah. So on those ones, I've noticed the buying power was considerably less. I was curious if it would be profitable or wise to maybe just take more of those.
Maybe.
Even though you know what I'm saying, like because of the BP is so much lower, taking those really safe bets that you were just going over might play out a little
It
bit. I don't
could.
know. Is that
It
something
could,
you've looked at?
however, just be careful if you do a lot of them. You're going to have a lot of those naked puts, and then it's going to cause like a big BP increase if the market drops a lot. So just be aware.
Okay.
But it does give more of a cushion because you have that larger width. So if the market dropped a lot and you're doing the bigger width ones over the smaller width, you're going to be able to cushion it a little bit better.
Right.
Here's a very This is one that I kind of thought of. This one, you're not going to make much in most conditions, but you're going to do really well if it. So I'm going to get out of that trade. I'll do ES. This is what I thought I just did recently. So I go really, really far out, 180 days. I'll show 170 for now. Where the expected move is, this little blue line, I'm going to start the debit spread here because then it costs less because I'm so far out of the thing. So I'm going to buy this, sell 300 away, sell the 4,500. It's only a 1375 debit for this. You make up to 300 on the width. You can make this much times 50 on ES. Woo!
Nice.
But then I want to find a way to pay for this because I don't want to just pay a debit and that's it. So what I did was I sold one put, not two, because I don't want to have a lot of notional value if the market drops. I sold one at this. So I sold one at around 14 or so. So it shows up. All right. So I might sell a 4150, just one. I have almost no initial credit, so you're not really making anything when you start the trade. However, you have that 300 width debit that could pay a ton, 14 grand. This is almost never going to work, but the one time it does, it's going to be great.
Right.
And then I could also consider rolling this. I'm going to roll the solds eventually. Did that one make sense?
Yeah, I have a trade similar than that I got off of you. Yeah.
Let me
So,
find
yeah,
where
it
it
makes
is.
sense.
It's this one. Yeah.
Yep, that's the one I got. Yep.
So yeah, the market's up. You're not going to make much on it, but I pretty much did this for break even when I started it. If I wanted to, I could roll the sold up. I wouldn't have a 300 width anymore. Let's say I want 150 width to roll up there. I could guarantee about 5 credit, 5 times 50. I can make 250 off it right now if I want it.
So it's a paid for protection.
Not completely paid for because my debit was
Yeah, 75 cents.
more.
Cost you 75 bucks.
No, this was the whole trade though. The debit was 46.5 minus 28.5. My total debit was 18. That's assuming that the naked put will decay to zero though. This could decay to zero, and then you took in the 1875. So the total trade was pretty much break even because this would go to zero. This goes to zero. I would only make 0.75. I'm going to wait because there's still plenty of time left. This might be a good campaign to do every month. I'm planning on doing every month. And then I'm going to roll it maybe 120 days out. Maybe roll again at 60 days or so out. Because remember, as you get closer to expiration, we don't necessarily need that big cushion because this 4,200 is so far away, especially if the market's not dropping, that this one will decay to zero. And that's what my plan is. Just let this go to zero pretty much. Another thing to look at is rolling up the naked put. I'm not much of a fan of it. I know Tom King does it sometimes. Some others do it, but I'm not much of a fan. The reason why is you need more buying power to do it. So this is one safeguard. It's already at a good profit. I could get out right now at $1,000 in 40 days. Normally I'd wait until this is at 90% decay and then just close it out and that's it. Leave this on for protection. What you can consider is, since this is so far away, 550 points away, I could roll this little put up and take in a little more credit. So this is still very safe. 0.03 delta. I think it was 0.06 or 0.07 delta when I started it. And I did a video on this recently. Let's say I roll up 100 points. I make another $100 or so because it's one credit times 2 contracts. That's 2 credit times 50. So you can make $100 this way. But I'm using more buying power to do that because I'm closer to the money now. So I'm using $700 buying power for it.
Hey, Lance,
Yeah,
I like to buy that naked put or the put back on the put debit spread and give myself a huge tent trap.
right.
Maybe
Then you have
it's
your
too
ratio.
big.
You have your ratio spread then, right?
Yep. No, I mean the downside protection is unbelievable.
Yeah, it's good. If and you can still make a good return even if none of it drops. It's not decayed enough yet, but if I looked at, I already closed some today. But if I close like this one, I closed the naked put already. I could close this too. It's a 90% profit. What I could do is just leave a 5,000 bought put hedge, and I don't even have to sold. I just have a bought put. That's a really good hedge, and I get buying power back. It's good. Yeah. Let me double check everything. I think that was off. So
If you
this
look
one,
at the one right below you, it's at 76%.
it is.
So if you take that one off, you give yourself that ratio spread.
Yep. And I get 4,000 buying power back. It's good. I like it. It's just if the market doesn't drop, you're paying this debit. So you're lowering the overall return if it didn't drop. But it's still fine. There's nothing wrong with it.
That's what I do is that's my plan for hedging my account is to buy
Yeah.
those back and give myself a huge ratio spread.
It makes sense. I think it's a good idea. It's definitely even more conservative because you have that bigger hedge. You just have the block put. Yeah, I like it. I'm just not really willing to do it yet.
Yeah, sure.
Let me look
Thanks
at
for your
it more.
time. I gotta head out.
Okay, sounds good. Thanks, Todd.
Thank you.
So what Todd was saying is in the put debit spread, the sold put, just close this out. And then you'd be left with one bought put here, 2 sold puts there. That's a huge trap. And that's called a ratio spread. That's where you bought one, sold 2. And eventually you can sell these too. And then you just have the bought put. And that's a really good hedge. All right. Any other last questions, Billy or Joseph?
Nope.
Nope.
It sounds good. Went a little longer than I thought, but this was fun.
Yeah, I was doing some work and looked at my phone and saw you were on, so I was like, hey, I'm jumping on.
There we go. If only
Thanks,
I was
Lance.
a teacher and I could do this anytime throughout the year, but I'm still teaching.
Oh man, that would be invaluable.
Yeah, but I still need my day job, I think. If I get 500 grand in my
Yeah.
tasting, maybe
I
I'll
may
think about it.
pick you up on some of my one-on-ones when I get my tasty thing changed over.
Sounds good.
Cool,
All
man.
right, guys.
Y'all
Have a good
one.
rest of the day.
Yep.
You too, Lance. Thank you.
No problem. Have a good one.